So if you had invested in the Russell 1000 value in October of 1999 and the Russell 1000 growth in October of 1999, 1 year later, your value investment would have been up 7.7%. Your growth investment would have been up 19.9%. And you would have said, why did I ever listen to that value person like she was an idiot? I really should have just put all my money in growth. But if you look 3 years later, that value investment would have been down 3.7%. The growth investment would have been down 16.8%. 5 years later, your total return on value would have been positive by 4.6%. Your growth investment would have still been negative 6.8%. Even 10 years later, your growth investment would have still been negative. And 15 years later, that value investment would have given you twice the return on the growth investment, 6.6% versus 3.3%. Now, are we suggesting that this is the sort of return you're going to see from value and growth going from here? No. I mean, obviously, 1999 was one of the extremes of all time. But it goes to show you how long it can take when you do invest in something at the top. When you do, try to put, all of your eggs in one basket, it can work out pretty badly. And so, making sure that you have some balance is really important. The other thing that we always like to talk about is that chart on the top that says this is a different kind of bubble. Sometimes people talk about the fact that, growth has been, sort of is getting into a bubble and value's been left behind. But if you look at other bubbles, I mean, the tech bubble, when it burst, went down, the stocks in the NASDAQ went down 77%. When Bitcoin burst, the 84% negative return that you had was pretty bad. The Dow in 1929, 89% from there to the bottom, and Miami homes in 2008, down 51%. But value since 2006, when it supposedly peaked, is still up 140%. So you may not have made quite as much as you made in growth, but it's also important to remember that we've actually still made good money in value, even taking into account the financial crisis and all of the negative returns that you had to the banks in that period. Now, I mentioned about the valuations being attractive. This chart on the left-hand side, I think, is a good visual to represent what I'm talking about. If you looked at the relative valuations of both value and growth to the broader market, what you see is that over time, there are periods where you get some extremes. Now, obviously here, this is growth in orange and value in blue. The orange in the late 90s got really up there, meaning that growth got really, really expensive compared to the broader market. And value, of course, was valued much, much less. Then we had a correction, and then we had some periods where things kind of came in and out of favor, and you saw the spread narrow and widen. Now, if you look at the spread between the two, it's pretty wide. Of course, not anywhere near as wide as 1999, but it's pretty wide. And what that to us says is that value is looking pretty attractive here. It's been pretty beaten up, and it looks pretty attractive compared to a lot of growth stocks. Now, the financials, which I mentioned before, are also a big piece of why we are very constructive on value. For those of you who aren't familiar with the style indices, financials represent about a quarter of the value benchmark. It's a much smaller piece of the growth benchmark. So it's hard to imagine that if financials actually do well and do have a period of outperformance, that value is not going to benefit. And I think some of these charts show why we think that the financials are so compelling here. If you look, for example, at financials in terms of the bank PE ratios, you can see compared to other time periods, relative to the market, they've rarely been cheaper when you're at a market peak. Financials relative to utilities. That's one of the other things that I always like to tell people. When you hear value, don't necessarily think I'm talking about utilities and telecom. A lot of times people think about value as being secularly challenged things that are cheap, but cheap for a reason. We actually own very little utilities in our portfolios because we do think a lot of them are too expensive. And if you look at the relative valuations of utilities to financials over time, you can see that rarely have financials looked as cheap versus utilities as they do today. And I think when you think about the fact that utilities are maybe going to have earnings growth of 3%, I mean, let's face it, they're regulated. They're only allowed to have a certain amount of return. It's hard to really imagine why you would want to pay 23 times, 24 times next year's earnings, which is what a lot of these things are trading at. And the other thing I always like to tell people is that it's not, even though utilities are known as the safe sector, the low beta sector, it's not without risk, and you don't have to look too much further than your own backyard at PG&E to realize that it's still a stock. It's not a bond, it's a stock, and it can still go down. And even if you don't have the types of issues that PG&E have had, just a re-rating of this sector from, say, on average, 21 times next year's earnings to 15 or 16 times next year's earnings, which, by the way, would still be not that cheap, would actually give you a lot of capital destruction. And so, we really feel like some of the traditional value sectors that people think of as safe, like utilities, are not that safe, whereas some of the sectors like financials that have traditionally been thought of as a little bit riskier are actually a much safer bet today. I mean, that might not always be the case, but today, given the valuations and given the capital positions that these banks are in. Oh, and then the other point that I think is interesting on the right-hand side of this chart is about the yield curve. One of the biggest questions I get when I'm talking about the financials is, well, the yield curve's flat. I mean, don't banks need a steep yield curve in order to make money? Well, not really. I mean, it's true that if you look at some of the capital markets names, yes, a steep yield curve is very helpful. If you look at life insurance companies, for sure, they need a steep yield curve. But if you look at your traditional regional bank, not so much. Most of the regional banks are making their money off of loans priced on the short end of the curve. And when we talk to the bank management teams of the banks we invest in, that's one of the things they told us back when short-term rates were zero. They would tell us, we don't really need long-term rates to go up. We really need the short end of the curve to go up because our loans are priced on the short end of the curve. They're priced at prime plus 2 or some deviation thereof. So the fact that we have a flat curve is not really a problem. If we were continuing to get cuts on the short end of the curve, that could be a problem. And so for bank investors, it's actually somewhat encouraging that the Fed this week said that they're likely to pause from here. If that did not hold up, I would be a little bit more concerned than I would be about the shape of the yield curve. And I think this chart on the bottom is giving you a really good indication that what the banks are telling us has a lot of truth, has a lot of validity. This chart on the lower right-hand side is showing the correlation between earnings and the change in the slope of the yield curve. So in other words, the change between the 2 and the 10-year, whether it's getting flatter or steeper. The PE change and the change in the slope of the yield curve and the returns to the stock prices and the shape of the yield curve. And so what you see is while the returns of these bank stock prices and the PE change actually have a pretty high correlation to changes in the shape of the yield curve, 66 and 62%, EPS growth only has a 33% correlation. So in other words, while the shape of the yield curve is certainly driving sentiment, it's certainly driving stock price changes, it's certainly driving PE changes, it's not driving earnings changes nearly as much, which means that what the bank management teams are telling us actually seems to hold up. They don't seem to be as dependent on a steeper yield curve as most people think. Does that make sense? The other thing I always like to tell people about the banks, or about financials, is that financials are not just banks. I mean, that is, yes, it is a big piece of the space, but keep in mind that the financials actually encompass a lot of different businesses that have a lot of different drivers. So it encompasses insurance companies. Within insurance, it encompasses property casualty names, life insurers, brokers. That it also encompasses credit card names, wealth managers, asset managers. And a lot of these businesses have very different paths of earnings. A lot of these businesses have a lot of different drivers. And so while a lot of people kind of tend to lump financials in one big bucket and just think that there's a couple of things driving it, such as interest rates and the economy, it's actually a much more diverse group of companies than you think. And if you look at what we own, this is one of our portfolios where we own 30% in financials, you see that we've got a lot of things outside of just banks. Banks are about maybe 10% of the total. You know, the other 20 is really in a lot of these other names, and with, frankly, a lot of differences in their performance patterns, in their earnings patterns. Probably the most interesting one to me is CME Group, which is the Chicago Merc. That's a name that we own in one of our portfolios, where I almost like to think about it as the perfect hedge to the rest of our financials, because usually whenever the rest of the financials are suffering, like last fall, and people are worried about recession, worried about risk, you know, in that period our banks were going down, some of our insurers were under pressure, asset managers were under pressure. CME Group was going through the roof because their volumes were going way up. When risk is up and people are worried, you see much higher volumes in terms of the derivatives that are traded on the Chicago Merc, and that stock actually did so well, it more than offset the negatives in the rest of the financials portfolio, and our financials actually made a positive contribution to our performance in the fourth quarter. Yeah, this I think chart on the left-hand side is a good representation of that. Basically, what this is showing is this year, each of these groups made a contribution to our performance in terms of stock selection, plus or minus. Overall, financials have added 67, getting dyslexic, 76 basis points of performance. That performance was mainly positive in most of these subcategories, but not in all. And so that's kind of the point. Diversified banks were the worst performers. They actually detracted 24 basis points. That's names like Bank of America, sort of your big universal banks. But on the other hand, our regional banks actually added 10 basis points. They've done pretty well this year. They've had pretty solid earnings. Property casualty insurance has had a great environment in terms of getting rate increases. They have contributed 19 basis points. So you can see that, you know, even though there were areas like diversified banks or life insurers who suffered because the long end of the curve came down, the other businesses have different drivers. We had more positives than negatives. And so even in a period where you had rates coming down, which you think of as, oh, bad time for financials, we were actually able to get positive performance out of the sector. This is my favorite slide because this is where I get to talk about technology, which I don't often get to talk about as a value investor. And I also get to tell people that technology is not only helping growth people, it's actually helping a lot of our value companies as well. It's just not as obvious. It's a little bit below the surface. It's a little bit sort of behind the scenes, as I like to put it. But nevertheless, technology is creating what I like to call more modest but yet long-term secular growth stories for a lot of the companies that we own. So if you use, for example, Deere as maybe a prime example of a company that is, you know, your typical kind of, you know, old school industrial, you know, real typical value stock, not a company that you would think about at all as being, you know, sexy or being able to utilize technology. They actually are benefiting greatly right now from technology because they're at the forefront of something called precision agriculture. And basically what that means is they're using artificial intelligence to create new tools for farmers that can, for example, discern weeds versus crops when they're spreading weed killer or spreading herbicides out in the field. Now, what that means is that farmers need to use a lot less weed killer, a lot less chemical to cover the same amount of farmland. It actually is a real game changer for farmers in terms of improving their profitability. You know, so that's the kind of thing that Deere is doing today that in our minds is making it, you know, not sort of just this stodgy old cyclical that's going to go up when the economy goes up and go down when the economy goes down. It's actually making it a more secular growth story. Or I like the story that I always hear about Walmart from our retail analyst when he went to visit their operations. They've made a huge investment in technology to improve their ability to compete with Amazon. And it's not only the front end, and you may see improvements in the front end in terms of your online experience when you go on Walmart's website, but they're also making a lot of improvements on the back end. So what Greg came back and told us was that he saw their fulfillment center for grocery. And of course, grocery is a really big piece of their business. It's actually a very important part of Walmart's business. And what they are doing is investing in technology so that they can fulfill orders at a much greater speed. And so one picker, as they call it, and a picker is basically the person who goes and picks out your grocery order when you place your order online. One picker can actually pick 7 or 8 orders in 20 minutes at Walmart. The comparable figure at a traditional grocer is 1 order in 20 minutes. So you think about it, 7 or 8 orders in the same time that a picker at a grocery store can do 1. That gives them a huge advantage, and that's the kind of thing they're doing to be able to compete with the likes of Amazon. My favorite story, I think, of all, though, is Columbia Sportswear. Which is utilizing technology in a lot of really cool ways, and also is able to utilize technology to not only improve their product line, but also to deal with tariffs. In terms of their products, I mean, they actually now have a jacket that is made of recycled plastic bottles, which I haven't actually seen the jacket, but I just think it's the coolest thing that you could actually make a jacket out of recycled plastic. But the thing that I thought was really clever was how they dealt with tariffs on shoes. And of course, in the garment industry, everybody's sort of nervous now about tariffs and how are people going to deal with this. And and especially in the value world, it's a big deal, because in our world, a lot of our companies, in the industrial space, tend to be more affected by tariffs. But in the garment area, they've been dealing with tariffs forever, because it's an area where we don't have a lot of production here. We haven't had a real industry here for a long time, and so there's always been a lot of groups like trying to get protection. They had a situation where they had a tariff put on their rubber-soled shoes, I think to the tune of about 35%. However, cloth-soled shoes only had a tariff of 10%. And you might say, well, why is that? Well, of course, who wants cloth-soled shoes, right? So that was the point. Was that they were trying to target specific companies that were making more advanced high-tech shoes. Well, what they did was they went back and created a really thin cloth to put at the bottom of their rubber-soled shoes, such that the first time you wore it, it wore off and you basically had rubber shoes. However, because of that cloth, they were able to only pay the 10% tariff instead of the 35% tariff. It was considered a cloth-soled shoe. So it's a good example of how companies can really manage around tariffs. If they know what the rules of the road are. And I would say, that's one of the things that we sometimes worry about. In fact, I'm going to jump ahead here for a minute. If you take a look at the U.S.-China trade war, the estimated impact on tariffs so far on earnings is minus 1.5%. So it really hasn't been that bad. But if you look at the impact on spending, CapEx spending, and if you look at the impact on CEO confidence, that's where the problem is. CEO confidence has come down. CapEx spending has come down. We can tell you, like from the companies we talk to, they've told us that, they've been sort of putting some of their plans on hold because they want to see what the rules of the road are. So to us, the problem is not so much that we may or may not have tariffs. The problem is we don't know what we're going to have. And our feeling is that we just need some sort of a resolution sooner rather than later so that people know what the rules of the road are. Because once they do, they can work around that. They can manage their businesses. That's one of the things we look for when we invest in companies, are management teams who are doing a good job of managing their businesses in all different types of environments. And they can do that if they know what the rules are. But when they don't know what the rules are, that's the problem. That's when you get the sort of the deer in the headlight sort of reaction, and that's what can be a much bigger problem for us. Now, maybe just to sort of finish off on the value versus growth story before making a few comments about the broader economy. This chart shows the performance of value and growth over time. And by the way, we don't have it on this chart, but not too many people realize that if you actually look at the performance of the value and growth benchmarks since their inception in the late 70s, the value benchmark is way ahead of growth in terms of the cumulative performance. But I think even more important than that is just the point that things come in and out of favor. We had a period here from 86 to 93 where performance was somewhat similar. From 94 to 99, we of course had a period where growth outperformed by a country mile. Then in 2000 to 2006, we had value outperforming growth by a wide margin. And now, of course, in the last 10 years, we've had this huge outperformance by growth. So, these periods happen, like things come in and out of style. And I would say, while again, I'm not expecting this sort of diversion because this was much more extreme than that, it's still been pretty extreme what we've had in the last 10 years. And so I would still expect that we are going to get at some point a period like 2000 to 2006, not quite as extreme, but nevertheless, a period where value actually regains some of the outperformance and some of the valuation that it's lost in the last 10 years. Now to maybe kind of pivot for a little bit to the general economy and the general market outlook. The biggest question I get probably after when is value going to start outperforming is when is the next recession? And of course it's important to every investor. It's really important to us as value investors because our companies do tend to be more reliant on the broader economy than growth companies do. And I can tell you that when we look at the indicators, and I would say those 5 indicators on the right-hand side are the biggest things that we look at. It doesn't tell us that a recession is coming in the immediate future. Have the risks increased? Yeah, absolutely. If I was showing this chart a year ago, bless you. Well, if I were showing you this chart a year ago, those blue lines would have been closer to the green side than they are today. So there's no question the risks have increased. But if you break it down and look at, for example, 3 things that still look, reasonably good, not booming, but reasonably good, are corporate profits. Corporate profits are still good. Change in employment. I mean, the employment market, as we've seen, is still very strong. And of course, wages are starting to grow up. I know Bank of America just announced that they're going to have a new minimum wage of $20 an hour, which is, a pretty amazing thing. High yield spread. That's still fine. We don't see a lot of signs of excess in the high yield market at this point. So those 3 are still fine. The 2 that have been wobbly are leading indicators and yield curve inversion. Now, leading indicators, I will tell you, while everybody's been concerned about the manufacturing slowdown, everybody's been concerned about the leading indicators for the manufacturing part of the economy, it's a pretty small piece of the market, and it's actually a pretty small piece of the U.S. economy. So while it is more important to a lot of countries overseas, and in fact we have seen a lot of other countries show much more weakness, countries like Germany. I mean, in our country, manufacturing is only about 15% of GDP. So it's not as bad a signal for us as it is for other countries in the world. What I would be much more concerned about, frankly, is if we saw the services indicators go down, because we're a service economy and we're a consumer economy. And we just actually had another reading on the leading indicators for the services part of the economy this morning, and it was fine. It was actually more than fine. It was 54, which is an increase from where it was, and a very encouraging sign. So I would still say, from the leading indicator standpoint, the one that matters, the services side of the economy, is still good. So that leaves us with the one negative, yield curve inversion. And of course, this is one that everybody is debating because, it normally, well, I shouldn't say normally, but in many cases, because it's not 100% accurate, but in many cases, when the yield curve inverts, you have a recession not too long after. However, I would tell you that in addition to the fact that it's not 100% accurate as an indicator, I would say in this low rate environment, it's even less of an accurate indicator than it usually is. Because if you think about where rates are in the world, and you think about all of the demand that we're seeing from foreign sources for our 10-year Treasury, that is distorting, I think, the signal to a large extent, because people aren't rushing into the 10-year Treasury because they're nervous. I mean, that's usually why that signals a recession, because people are nervous. And so what do you do when you're nervous? You go for the safest thing. You go for the 10-year Treasury. But the reason why people are going into the 10-year Treasury in such large numbers is because they can't get yields anywhere else in the world. They're getting negative yields in places like Germany. And so to me, that doesn't signal fear. It just signals that we're kind of the best house on a bad block. And so for that reason, I don't take that signal to be quite as negative as it would be in a more normal rate environment. But again, all of that being said, these numbers, these indicators, were much more over to the right than a year ago than they are today, and so we are keeping an eye on it. But for 2020, I would say we feel pretty comfortable right now that without some sort of exogenous event, some sort of geopolitical event, or just something that you can't predict, it just doesn't seem like the seeds for recession have been laid at this point. Now, I just want to say a couple of words about earnings, and then I'll open it up to any questions that you might have. Earnings are still good. They're not as great as they were, but they're still good. This year, we're predicting 2% earnings growth. The reason why the market, of course, is up so much more is because we came into the year with valuations at a pretty low level after the sort of recession scare of the fall of 2018. But 2% is still good. Now, next year, the consensus for earnings growth is 10%. Our analysts are predicting 9%. I feel pretty secure in saying that we're not going to get 9 or 10% earnings growth next year. And that's usually the case. Usually this early on, you get an overly optimistic view of earnings, and usually those numbers come down. And I think this year is going to be no different. That being said, even if that 9% came down to, let's say, even like 4 or 5%, if our companies can earn 4 or 5% next year in terms of earnings growth, if you get a 2% dividend yield on top of that, and prices go up roughly in line with earnings, then you're still talking about a 6-7% return from equity markets, which is not bad. And that's kind of our base case right now for 2020. Again, barring any kind of exogenous events. Valuations, while not cheap, are not terribly expensive either. Right now, the forward PE is 16.8, which is kind of right in line with long-term averages. So it's not, certainly a buying signal, but it's not signaling a bubble either. And then, one other thing I just want to mention quickly about PE ratios. Keep in mind that PE ratios are very much tied to interest rates. So if you take a look at this top chart, this is showing the average PEs depending on where the 10-year Treasury is. What you see is if the 10-year Treasury is 0 to 2, 2 to 4, 4 to 6%, you've actually got PE ratios on average in the high teens, anywhere from 16.7 to 19.5. It's not until you get to interest rates above 6% that those numbers start coming down. So when you hear that, you hear people saying, well, the market doesn't look that cheap. Keep in mind that, a 16.5% PE or 16.5 times PE is not that expensive given where we are in terms of interest rates. Same thing at the bottom with inflation. Typically when inflation is high, then that's also when PEs start to come down because you're eroding the power of those future earnings. Right now, with inflation very low, very modest, PEs really at 16.4 are not high at all. In fact, on average, when inflation is 0 to 2%, the PE ratio is 18.2. When it's 2 to 4%, it's 17.4. So that, I think, also kind of puts in perspective, where the PEs are today, and why we don't necessarily think that they are excessive. then finally, this chart, which was put together at the beginning of the year when our global investors from all across the world come together to talk about what they're seeing, what they think the opportunity is, what they think the risks are. This kind of shows what they said or what they were either most worried about or most optimistic about. And the words on here that are in the biggest letters are the things that were mentioned the most. And so those are the things that we like to pay a lot of attention to, because frankly, if investors from all over the world are saying something, that, that to us is very powerful. And I would say at the beginning of the year and probably today, you would see a lot of the same words being sort of bold-faced. Banks, tech, value, financials, quality are all areas that investors around the world at our firm thought were very interesting. Worst opportunity by far was commodities, although consumer staples and European banks also came up as areas that people were not really jazzed about. And biggest risk globally, trade war and recession, predictably enough, were the two that came up. And I would say, as we get to almost the end of the year now, those would probably be the same two things that people would say that they worry about.